We have learned in the earlier classes about swap differences arising on cancellation of forward contracts, particularly when the bank itself covers its position in the forex market. We have dealt with situations of cancellation on the spot, cancellation happening at a delayed date where bank had to wait because of FEDAI rules application. We have even learned concepts of swap loss. Now, how would you apply all these concepts in much simpler scenario that would be classified as basically the matter of early delivery? How would you deal with early delivery? Much easier scenario, but you should be confidently dealing with this as well. So what I'll do is, I'll explain to you that early delivery can happen in case of exporter, early delivery can happen in case of importer as well. So we'll deal with both cases one by one. Let us first talk about early delivery in case of exporter. So let's say a scenario. An exporter that has made exports will be receiving money at the settlement in the foreign currency. Suppose that is not a spot transaction and the exporter is going to receive that foreign currency amount at a little later date. It will be in a risk because that later date you don't have assurance of what money you can actually get in your domestic currency. So what generally exporters do? Exporters enter into a forward contract to hedge their receivables. Correct? Here I am not saying hedge their liability, hedge their receivables. So exporters will enter into forward contract to hedge their receivables. And how do they do that? By entering into a forward contract to sell foreign currency. Now suppose in our example, exporter is giving 3 months time to its customer, the overseas buyer or overseas customer. But we have seen earlier also that there may be a possibility that the overseas customer wants to settle its obligation before the maturity and they remit the amount, say 1 month prior to the settlement date. Can we agree that this could be a possibility? In that case, because of this possibility, there would be a need for doing something, some action has to be taken by exporter. So what happens? The amount that was supposed to come after 3 months has been received just after 2 months, that is 1 month before the actual settlement date. The exporter has hedged its position with the bank, and let us assume that bank has also covered its position in the forex market with some other bank. In that case, if there is any cancellation of contract between the exporter and the bank, there has to be a cancellation of contract between the bank and the other bank in forex market as well, because there will be a chain of contracts, one gets cancelled, other also by default gets cancelled. Of course, by default gets cancelled means you have to take action to cancel that. Automatically it won't get cancelled. So what will be the scenario? On early receipt of that foreign currency, the exporter will have no choice but to sell spot that amount, and whatever be the spot rate, based on that it will have to receive money. But because it has hedged its position, it can execute the contract at the original contracted forward rate, but then bank will have to swap its position because of the exporter's requirement, and any loss arising to bank on that swap, the exporter will have to bear that loss. Not only that, bank was supposed to make the final payment to the exporter 3 months after, but bank is going to face any kind of outlay of funds prior to the 3 months. It will be again happening because of the exporter's requirement, and bank will have right to recover interest on outlay of funds. So in this kind of scenario, you are going to compute couple of things. swap loss arising to the bank, which bank will recover from the customer, and temporary outlay of funds because of this 1 month difference. That amount is bank's loss. Bank cannot recover that amount from customer. Bank can recover swap loss, but any additional outlay of funds happening to square off all these positions, bank cannot recover that from the customer. But if bank has had an outlay, or I would say if bank had an outlay of funds on the payment date to the exporter, bank can recover interest on that net outlay of funds for that 1 month difference. Why I am talking about this as a 1 month difference? Because in my example, the original contract was for 3 months forward, and after 2 months expiry, the exporter is willing to close the contract or go for the early settlement, and that early settlement is happening 1 month prior to the original maturity date. So what I'll do is, one of the questions asked in past exam and which is given in your book, that is question number 112. Let us read that question, and we will deal with this question and take the facts and figures from this to arrive at the whole matter. What I'll do is, I'll first read the question for you, okay, and explain to you one thing, that the example what I was talking about, this question is revealing exactly similar kind of facts. So let us do the question reading work first. Question 112. On 1st January 2019, Global Limited, an exporter, entered into a forward contract with BBC Bank to sell $2 lakh on 31st March 2019 at rupees 71.50 per dollar. That means exporter has entered into a contract with BBC Bank on 1st January, and contract is to be settled on 31st March. January, February, March, 3 months contract. It is implied that the exporter would have planned to receive the settlement from the customer, that is from the exporter's customer, who could be an overseas buyer or overseas importer. That party would settle the payment on 31st March, and bank will sell that $2 lakh to BBC Bank on 31st March at contracted forward rate of 71.50, irrespective of any rate prevailing on that date. So understand one thing, who has taken the hedge position? Global Limited in this case has taken the hedge position, which is an exporter. If Global Limited is taking a hedge position, counterparty, that is bank is taking the risk. That means if bank had to provide the settlement at 71.50, means Global Limited will sell $2 lakh to bank at 71.50, and bank will have to sell it in the Forex market. If bank has to sell it in the Forex market at any different rate than 71.50, of course it will be a little different rate, because bank will sell that $2 lakh in Forex market at the interbank rate, either prevailing on that date, or bank will also cover its position depending on situations. In that case, if Global Limited has taken a hedge position with the bank, it is the bank who is taking the risk, and if bank does not want to take the risk, bank will again cover itself with some other bank in the Forex market. That is the conceptual scenario. Now, the question further reads this way: however, due to the request of the importer's request, Global Limited received the amount on 28th February 2019. So basically 1 month prior, exactly similar scenario what I was talking about, okay, some time back. So 1 month prior, the importer has requested the exporter that please receive the payment early, and Global Limited has received the amount on 28th February. Global Limited requested bank to take delivery of the remittance on this date. So Global Limited had no choice but to accept that payment in USD, but because it cannot hold USD in India, what the exporter had to do, it has to request the bank for early settlement. and that early settlement is happening 1 month prior to maturity. So on 28th February, the interbank rates were given, spot rate in bid and ask format, and 1 month premium given. This is basically the swap points, so you know how to adjust the swap points with the spot rate to arrive at forward rates. If the bank agrees to take delivery, then what will be the net inflow to Global Limited? Assuming the prevailing prime lending rate is 15% and assume 365 days in a year. So we have read the question. It is exactly similar type of scenario what we were talking about, and what I am going to do is I am going to put forward the whole scenario in the question much more clearly presented in front of you. That may not be part of the solution, so I would recommend, in case you are interested to take that thing into your notice, you can take that screenshot once I display that, okay, and the later part onwards where the solution actually begins, from that point you can start writing the solution. So let us just move to the solution part, and I'll tell you how to approach the whole scenario. So in this case, you would first mention that on 1st January 2019, Global Limited approached BBC Bank and booked the forward contract to sell $2 lakh on 31st March 2019 at rupees 71.50 per USD. On 1st January 2019, BBC Bank would have already made a contract in the market to sell USD forward on 31st March 2019. Now this is, maybe we can say that our assumption of the scenario, that bank would have also covered itself in the forex market. Why we are assuming something like this? See, $2 lakh is not a small sum, okay, it's a big amount. If Global Limited is selling $2 lakh to the bank on 31st March at the contracted forward rate of 71.50, it is obvious that bank is not going to hold that $2 lakh with itself. It would have taken a counter position to sell these dollars in forex market, and I am telling you, it would have taken a rate higher than 71.50 guaranteed, because this is the forward bid rate quoted by BBC Bank to Global Limited, which is an exporter. So this is the retail bid rate, but the wholesale bid rate, which applies in the forex market as an interbank rate, must have been higher than 71.50. If you can recollect the core concepts that we have learnt earlier, from the interbank bid rate, you will subtract the margin for the bank to arrive at the applicable bid rate for the customer. So customer in this case is Global Limited. For arriving at this rate, imagine what you would have done from bank's viewpoint. You would have picked interbank bid rate, from that you would have subtracted bank's margin and arrive at the retail bid rate that the bank is quoting to the exporter. That is why bank will quote this rate to Global Limited. So what Global Limited is going to do? Global Limited is going to sell $2 lakh to bank at 71.50. Bank will sell this in forex market at a rate higher than 71.50. So bank has also covered itself. We don't know that angle at what rate bank has covered. We are assuming that bank must have covered itself, that you understand. If bank doesn't cover itself, then bank will have to suffer with any resulting gain or loss, because if Global Limited is hedging its risk, counterparty becomes bank. Bank will have to take that risk, correct? This is how hedging happens, right? One party hedging its position, it is shedding away its risk, it is transferring its risk to another party. If bank also doesn't want to take risk, it will also have covered its position in the forex market. That is what we are assuming over here. So I believe you are clear with this assumption that we have taken. Moving forward in the scenario, we would now say, On 28th February 2019, the buyer had made the payment earlier than expected. Now that Global Limited wanted to settle early, the bank had to reverse its position. Because bank had covered its position is our assumption, bank will also have to reverse its position, selling dollars in the market 1 month earlier than planned. Now, how to do this? I am going to explain that to you, but this is the summary of the question that we have interpreted. I would say just quickly take a screenshot. You may not write this as part of the solution in examination, but for your own understanding, you can quickly take a screenshot over here. Alright friends, I am sure you would have taken the screenshot by now. Now, this was not part of the solution. This is something for your own understanding. Now, if I take the solution beginning, I would say Global Limited, that is the exporter, and BBC Bank, they have entered into a contract. Which date they have entered into a contract? 1st January 2019, they have entered into a contract. What kind of contract? That Global Limited will sell $2 lakh 3 months forward at what rate? 71.50, that is rupees 71.50 per dollar. This is the contract between the two parties on which date? 1st January 2019. The contract is supposed to be settled on 31st March 2019. After 2 months, the exporter, so who is the exporter? Exporter is Global Limited. Exporter needs early delivery. Why exporter needs early delivery? Because the overseas importer has remitted the payment earlier. So overseas importer requested the Global Limited that please accept the remittance earlier. Actually, it's a good sign that if you are getting money earlier, right? 1 month earlier. So basically, just imagine, there may be some swap loss and these components that may arise as a loss to Global Limited eventually. But use your simple common sense. If you are receiving money 1 month earlier, not a small sum of money, $2 lakh, if you are receiving 1 month early, you can happily enjoy interest income on that for 1 month. You can enjoy that interest income for 1 month. Yes or no? So there may be losses arising on settlement or on accepting this as an early delivery or early closure of your contract. But in spite of those losses, the interest on that $2 lakh will be a huge amount, correct? In rupee value, it will go into crores of rupee, correct? And crores of rupee for 1 month, if you are getting interest on that, it itself is a big benefit, right? So all these swap losses and these small settlement differences will not matter to the exporter. So in a way, you understand one thing, Global Limited in this case, one side it could be little tensed that it has to, do something, take action to square off the matter early. But back of its mind, it is having a much bigger opportunity to utilize that money for 1 month additional. So it's all win-win situation for Global Limited actually. So we are going to compute some losses, and when you are selling $2 lakh at 71.50 per dollar, whatever money you were supposed to receive, obviously because of some losses you are going to receive a little lesser amount of that money, correct? That little lesser amount money that you receive is all okay, because eventually that much money you can invest for 1 month and earn interest on that. Eventually on 31st March, when the final settlement was supposed to happen, Global Limited will end up earning bigger amount of interest to compensate all these losses. In other words, on 31st March, the actual money in hand for Global Limited would be definitely more than what it would have obtained earlier. As in, if there was no change happening, if on the normal course, if the exporter is receiving $2 lakh on 31st March, converting that at 71.5, whatever money it would have received, more money will be in the hands of Global Limited, that is the exporter, on 31st March. we are not considering that aspect, because in this question they did not mention to you what will be the interest income that Global Limited can earn on investing money locally, correct? But that in real life should be a factor which cannot be ignored. ICAI has done a smart thing, which I think in my book I have given in question number 113, that is the next follow-up question. There they have included this point as well, that if the importer, overseas importer, is willing to make early payment, exporter can do two things. Number one, receive the early remittance and take the acceptance of contract delivery on early basis. In other words, it is going for early delivery of the contract. That is one alternative. Another alternative is the importer will be asked by our Indian exporter that please don't remit the money now. You want to make the payment, on behalf of us you deposit this money locally over there somewhere in the US itself. In that case, whatever money the customer, that is the importer, is depositing in the US, whatever be the deposit rate prevailing in the USA, that will be earned by our exporter in India. And after that, without any changes in the forward contract, that money can be straight away received locally, correct? In other words, after a month of making that deposit in US dollar itself, the principal amount deposited plus the interest thereon earned over there in 1 month time, that whole money can be remitted at the usual date, and the settlement of the forward contract can happen again in the usual manner, not resulting into any kind of losses for the exporter, instead earning some additional income in the form of interest, which is because of deposit made in the US dollar itself in the USA. Now, is that more beneficial, of bringing money in India for early settlement of the contract? Is that more beneficial? That also we are going to discuss in our examples ahead. So I believe conceptually you all must be clear with this point by now. So after 2 months, exporter needs early delivery. What will be the outcome? The remittance by overseas customer comes to BBC Bank on 28th February 2019, that is a month prior. BBC Bank needs to take two actions. Now it cannot just automatically square off the same original contract without performing additional actions, because the original contract was not supposed to be settled on 28th February 2019. Original contract was supposed to be settled on 31st March 2019. So what will happen? Understand logically. The bank has taken a position in the Forex market. So if Global Limited is selling $2 lakh to the bank, bank would have agreed to sell $2 lakh in the Forex market, and that is supposed to happen on 31st March. But bank has received the amount of US dollar now. So bank will have to sell that in the market as spot, because bank will not be holding that $2 lakh. What will bank do with that unnecessary quantity of dollar? The bank will sell it spot. But what about bank's position with the Forex market, which we are assuming bank would have covered itself in the Forex market, where bank will sell $2 lakh in Forex market on 31st March 2019. So if bank has to sell on 31st March, that contract of the BBC Bank with other bank in Forex market will need a cancellation. For that, BBC Bank will have to take a reverse position. Taking reverse position means if it has agreed to sell dollars earlier, now it will have to take a 1 month forward position to buy dollars. That means it will have to buy 1 month forward, and for the early acceptance of this dollar, that is $2 lakh remitted by the importer, that will have to be sell spot. That means you have to sell spot that dollar and buy 1 month forward. That means you are swapping your position, which may result into a swap gain or sometimes a swap loss. So let us look into what is happening in this scenario. it will have to sell spot at rupees 71.20. This is the interbank spot bid rate. This is interbank rate, not the rate applicable to the customer. So 71.20 is the rate at which bank will sell $2 lakh and bank will have to buy 1 month forward. So if you observe the question, in the question they have given the spot rate on 28th February and they have given 1 month swap points which are premium points. So premium points obviously you are going to add. So look at the question, the interbank spot ask rate that is given was 71.25. To that you add 10 points which are 10 points premium, it will result into 71.35. For closing, now who is going to enter into 1 month forward buy contract? The BBC Bank. BBC Bank would have entered into a 1 month forward buy contract to close its position in Forex market. So it is basically cancelling its position in the Forex market. Now look at one thing, it is selling at 71.20 and it is agreeing to buy at 71.35, agreeing to buy at a rate higher than the rate at which it is selling USD. Obviously if you are buying at a higher rate and selling at a lower rate, you are suffering with a loss. This is basically the swap loss. As per FEDAI rules, this swap loss, difference between these two rates multiplied by the foreign currency amount of $2 lakh, it will come to rupees 30,000. This loss bank has suffered because of Global Limited. As per FEDAI rules, bank is having all the rights to recover this loss from the customer. That is the Global Limited, which is exporter in this case. This what I have presented over here is definitely part of your solution, which I would want you to note it down quickly. Let us move ahead, and now we mention the fact that bank will definitely recover this swap loss from Global Limited. Apart from swap loss, Global Limited will also have to pay interest on outlay of funds by bank for effecting an early settlement. Now what about this outflow of funds by bank on 28th February, because bank is going to have right to recover interest on that. As I told you, bank has just cancelled its original contract at what rate do you know? 71.35. And I told you bank would have originally agreed to sell dollars at a rate even higher than 71.5. So when bank is cancelling its contract in the Forex market, it will earn a big amount from there, correct? So bank is going to earn something from the cancellation of its contract. However, the swap loss bank will recover from the customer. But do you know, on 28th February, bank will have to have an outlay of funds from its pocket because of the exporter's requirement of early settlement. How? Let me tell you. What was the spot bid rate prevailing on 28th February? 71.20, correct? Correct, 71.20. Spot bid rate, which is interbank rate, of course. Do you know what BBC Bank will have to do? BBC Bank will have to sell $2 lakh at 71.20. But it has promised to buy the same thing from Global Limited, because Global Limited was supposed to sell, bank was supposed to buy at 71.5. So it is selling in the market at 71.2 and buying from the customer, that is Global Limited, at 71.5. Now obviously this portion of loss bank will have to bear, because this is not a swap loss which bank can recover from the customer. It is part of the cancellation cost, and bank would have already made gains in the Forex market because of this cancellation. I have explained to you why bank will make a gain over there, because bank is eventually cancelling the contract by making a forward buy at 71.35, and the original forward sell contract bank would have entered in the Forex market at a rate even higher than 71.50. Now this outlay of funds bank will have to have on 28th February, and we will consider the 1 month interest on that to be compensated by Global Limited, because bank would have suffered with its portion of cancellation and other losses being a counterparty to a hedge position on 31st March, but because of Global Limited, the bank has to have this outflow 1 month prior. So the outflow itself cannot be recovered from the exporter, but the interest thereon definitely will be recovered. So how would you compute that? On 28th February 2019, bank buys from Global Limited $2 lakh at 71.50, which it has promised, correct? 1 crore 43 lakhs is what the bank will pay to Global Limited, and bank itself will recover how much from the forex market by selling $2 lakh in the forex market at the spot bid rate, interbank spot bid rate, which was 71.20. Bank will recover 1 crore 42 lakh 40,000. So do you know the amount which we have considered over here, 1 crore 43 lakhs, is the inflow to Global Limited. So from bank's viewpoint, it is an outflow, and whatever bank is getting by selling $2 lakh in the forex market, that will be the inflow for the bank. Now the difference between that two outflows and inflows, because outflow is bigger and inflow is smaller, for the bank the net outflow is 60,000. Understand one thing clearly, this 60,000 is something that bank has to bear, because against that it has made a big amount of gain. Bank has to bear that 60,000, but because bank had to have this outlay of funds a month prior, on this amount bank will recover interest from Global Limited. So before I take you any further in the explanation, quickly take note of this calculation as well. Let us move ahead and we compute the interest on outlay of funds for 31 days, that is from 28th February 2019 to 31st March 2019, entire month of March, 31 days. 60,000 into 15% into 31 by 365 gives you 764.38, which can be rounded off to rupees 764. So what will be the charges for early delivery? The swap loss that bank will recover from Global Limited, that will be rupees 30,000, and interest on outlay of funds will be 764. So total amount that bank will recover from Global Limited will be rupees 30,764. So what will be the net inflow to Global Limited? Original contracted rate for selling $2 lakh for Global Limited was rupees 71.50 per dollar. That rate multiplied to $2 lakh, it gives you inflow of 1 crore 43 lakhs for Global Limited, but Global Limited will have to bear this cost 30,764. So this charge is subtracted from the gross remittance or the gross proceeds. The net proceeds in the hands of Global Limited will be 1 crore 42 lakh 69,236. With this, the entire solution comes to an end.